Hello, Marc Ostwald from ADM Investor Services International, with some thoughts on the inflation pressures that are out there in the world, particularly as seen through the lens of central bank policies, and the fact that most of them actually think these inflation pressures will prove to be transitory as the world goes into its economic recovery, or hoped for economic recovery after the pandemic. But also looking at what we've got in terms of supply chain pressures which are emerging in the world. So my first chart this week is 5-year break-even inflation rates. These basically, I've looked at a broad spectrum here to highlight a couple of different points. First of all, the break-even inflation rates in the US are those which have risen the most sharply. In part a reflection of the strength of the US economic recovery. We obviously don't actually have a break-even inflation rate for China here, but I'm sure that would also be very high. We see that behind the US, we've got Australia and Canada, i.e. the dollar block currencies and commodity currencies, also rising fairly sharply, but not to the same extent as the US. They're only marginally above the levels that we were in 2018. And as much as the UK is at the top of that chart, what one can certainly observe from that the break-even inflation pressures that are discounted in the market are not really significantly higher than they were 3 years ago. By contrast, we have seen a rebound in both Germany and Japan, but the absolute level of break-even inflation rates in both those countries suggests that there are still substantial structural headwinds to inflation increasing in both of them, and neither are actually above the levels that they were in 2018. So what's driving a lot of these inflation pressures? We come to my next chart, which is the Goldman Sachs Commodity Price Index. It's significant in the sense that we are now actually above the levels that we were not only pre-crisis, but also the levels that we were back in 2018. A lot of this is definitely being driven by oil prices, which has obviously had a seismic rise, particularly in the last 3 to 4 months, as well as by industrial metals. There are clearly supply shortages there and supply disruptions. The bigger question is how much of this is actually being contributed because of expected demand from more climate-friendly production processes, which suggests that we're going to have a bigger demand on certain types of industrial metals as we go forward. And we don't really know whether there really is the supply capacity there. So we come to my third chart, which is the ISM Supplier Delivery Times Index. And this is a much longer term chart, simply to make a very simple point. It's now back at the sort of levels that we saw during the immense pressures immediately when we started having lockdown around the world, above all China and the US and Europe. And we're almost back up at those peaks, which are way above the levels that we have seen over the last 20 years. There are clearly very sharp supplier delivery chain problems here, and that is going to have an impact on inflation. It's debatable at the moment, and it is going to be a key issue as we go forward, whether these are actually going to be transitory or far more durable. And the big question here really boils down to the point, how much actual production capacity have we lost? It would appear that we have lost quite a substantial amount, and in certain sectors that's having a bigger impact than others immediately. One of those is obviously the auto sector. This is my fourth chart, which shows estimated losses due to the shortage of supply of semiconductors for the auto sector. One might say 61 billion isn't a great deal of money in the greater scheme of things, given the huge amount of extra liquidity. Finally, my final chart is the SOX Semiconductor Index, underlining that this has risen 137%. As opposed to 78% for the S&P 500, and benefiting clearly the big semiconductor makers. Those are the thoughts for this week.